Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Verizon.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave in the comments section below.
So let's get into the analysis.
Okay, let's unpack this. For the last few years, the story around Verizon has been, well, complex. Massive capital expenditure, building out 5G, intense competition, and a stock price that really reflected all that uncertainty.
Right.
But now it feels like we've turned a corner. We're seeing management talk about a return to, modest, steady growth. Why is this the moment for investors to maybe reconsider this massive telecom?
It's all about stability and the shifting dynamics of their core business.
Okay.
The foundation of the current bullish case is that their main wireless engine is now showing consistent, reliable forward momentum. It's not just spinning its wheels anymore.
And we're seeing that in the numbers.
We are. Look at the third quarter of 2025. Total wireless service revenue hit $21 billion. That was up about 2% year over year.
2%. That's stable, sure. But in a world obsessed with hyper-growth tech, is 2% truly enough to drive meaningful returns for a giant company like this?
That's the thing. It's not about the top-line number alone. It's about the quality of that growth and how it feeds into their incredible cash flow machine.
The cash flow, right.
Management is guiding for 2.0 to 2.8% growth in wireless services for the full year, and that stabilization is really anchored by the consumer side.
And the consumer segment is truly the behemoth here, isn't it?
Absolutely. Consumer revenue grew 2.9% year over year to $26.1 billion in the quarter. And that was specifically driven by consumer wireless services growing 2.4%.
So that's the core mobile market doing the heavy lifting.
That's the sustained loyalty. That's what's driving the stability we're talking about.
Okay, so if the consumer side is the engine, the business side is the one that raises some questions for me. The headline number for Verizon business revenue shows a decline. It was down nearly 3% year over year to $7.1 billion. That sounds like a business that's shrinking.
And that's fair, but you have to look past that top line and really examine the composition.
What's underneath it?
So that total revenue number is shrinking because they are aggressively shedding low-margin legacy wireline services that just don't fit their strategic direction anymore. What matters for the future is the high-margin business wireless service revenue.
And how did that do?
That actually grew 0.7% year over year.
So they're prioritizing profitable customers over just maximizing gross revenue.
Precisely, and you can already see the impact of that cost discipline in their profitability metrics. Business operating income actually increased 12.7% year over year.
12%, wow.
It's a clear signal. The strategy of focusing on the most profitable wireless additions and, cutting out the dead weight is structurally improving their margins, even if the total segment revenue looks a bit soft.
Okay, so the revenue structure is getting healthier. How does that translate to the bottom line? What kind of earnings growth are we actually seeing?
Management reaffirmed their full-year 2025 guidance. They're targeting adjusted EBITDA growth of 2.5 to 3.5% and adjusted EPS growth of 1.0 to 3.0%.
And for our listeners, that EBITDA growth is particularly important, right?
It is, because it strips out the massive depreciation charges tied to that multi-year 5G build-out. Seeing that metric stabilize around 3%, it just reinforces that story of returning consistency.
And what's the street thinking?
Well, the consensus for 2025 EPS is around $4.70 a share, and sentiment has been improving. We've actually seen 3 analysts raise their full-year estimates in just the past 60 days.
So now we get to the central thesis, the real reason why value and income investors look at this stock: free cash flow.
Their superpower.
It really is. What kind of FCF juggernaut are we actually talking about here?
We're talking about massive, almost fortress-like cash flow. Management is guiding for robust FCF of between $19.5 billion and $20.5 billion in 2025.
Just to put that in perspective, that scale of guaranteed cash generation is it's just monumental.
It is. And based on projections, that FCF is expected to climb even further. It could potentially reach $23.4 billion by 2029. That kind of predictable, growing cash is the bedrock for the entire investment case.
And what makes this even more powerful now is the changing role of capital expenditures, or CapEx.
Exactly.
We know they had to spend so heavily for years to get 5G up and running, but that phase seems to be wrapping up.
It is. CapEx guidance for 2025 is between 17.5 billion and 18.5 billion, which is either within or below their prior target range.
So what does that structural decline in network building costs mean for the cash that investors actually care about?
It creates a structural boost to FCF conversion. Think of it like this.
Okay.
The massive 5G build was the down payment on a huge asset. Now that the peak spending is behind them, more of every dollar of revenue is free cash.
Cash that doesn't need to be immediately plowed back into building towers or spectrum.
Exactly. It's available for paying down debt or returning to shareholders. This declining intensity is a huge positive for the balance sheet.
And that strong FCF conversion is why the dividend story is so compelling, isn't it? They've raised it for 19 consecutive years.
19 years.
But given that substantial debt load, how secure is that dividend really? And what options does that cash flow open up for them?
The dividend is extremely secure. The guided FCF, nearly $20 billion, is well in excess of their annual dividend payment requirement.
So it's a huge buffer.
A huge buffer. It allows for continued annual increases, and crucially, it gives them optionality. Once they normalize their leverage ratio further, which is a major goal, that surplus cash can be redirected towards share repurchases.
And that would be a powerful additional catalyst for the stock.
A very powerful catalyst.
Okay, so the fundamentals are stabilizing, the cash flow is incredible. But if the money is there, where are they focusing their firepower to retain customers and grow? What's the structural advantage or moat that keeps customers sticky in such a competitive landscape?
Well, the primary moat is still the scale of their wireless network and the associated switching costs.
The network quality.
Right, they command a certain pricing power because of their long-established reputation for quality. But the mechanism that truly locks customers in now is convergence, the strategy of bundling multiple services together.
How sticky does that convergence really make a customer, though? Is it a marginal difference or a fundamental change in the relationship?
I'd say it's a fundamental shift. We now see that over 18% of their consumer postpaid phone customers use a converged offering.
Meaning they bundle wireless with a home broadband product?
Exactly. And when a customer relies on you for both their phone connection and their home internet, the friction of switching is just dramatically higher. It deepens retention, and critically, it drives up their average revenue per user, or ARPU.
So the customer pays more and stays longer.
That's the goal.
And speaking of broadband, the numbers there look explosive. It seems to be the key to their future growth.
It really is. Total broadband connections are strong, up 11.1% year over year to over 13.2 million.
Where specifically is that growth coming from, and how is it pushing back against competitors like the cable companies?
So that growth is coming from two successful product lines that are operating in tandem. If we look at the third quarter of 2025, they had 306,000 total net adds.
Okay.
The lion's share, 261,000, came from fixed wireless access, or FWA. This FWA offering, which uses their 5G network to deliver home internet, it's a game changer. They now have a base of about 5.4 million FWA subscribers.
FWA is definitely the volume driver then. It gives them a low-cost, rapidly deployable solution.
It is.
But what about Fios, their traditional fiber product? Has that just been neglected?
Not at all, and this is a key sign of execution. Fios Internet actually delivered 61,000 net adds in the quarter.
61,000.
That's their best quarterly result in 2 years. So they are succeeding with the high-speed, high-quality fiber product, and they are leveraging their wireless infrastructure for that massive volume growth from FWA.
The dual-engine approach.
It is, and that's what truly expands their addressable market beyond just the saturated mobile phone business.
And beyond the numbers, the CEO, Dan Schulman, has been committed to a massive cost structure transformation. He talks about bold and fiscally responsible action.
Right.
What does this focus on internal efficiencies suggest about their competitive stance going forward, especially against discount rivals?
It suggests they are proactively optimizing their business model to be leaner and more agile. This isn't just trimming fat. It's about reshaping the culture to be truly customer first and ensuring their operating leverage is maximized.
So it's about improving margins.
Improving margins, and when you combine that cost transformation with the structural advantages of their network quality and the scale economics of 5G and FWA, you have a durable competitive position. They're setting the stage to execute regardless of how aggressive rivals get on pricing.
That's the operational story. But what does this all mean when we look at the stock price itself? By traditional metrics, is this cheap right now?
It is framed by value strategists as significantly undervalued. It's frequently highlighted as a top value stock with a forward price to earnings ratio of just 8.76.
8.76. I mean, when you see a high-quality asset with stabilized earnings trading at less than 9 times forward earnings, that signals deep skepticism from the market or a huge opportunity.
Exactly.
Well, if the PE is that low, what do the detailed modeling analysts, the bean counters, think the intrinsic value should be?
Well, discounted cash flow analysis, which is perfect for a company generating $20 billion in predictable cash, suggests the stock is currently trading at a steep discount relative to its inherent worth.
How steep?
In some models, that discount is as high as 63%. Fair value targets are often placed closer to $58 compared to a cautious floor near 42.
So there's a huge gap there.
A huge gap. It implies the market is currently pricing in a lot of risk that may not be fully warranted by the underlying fundamentals.
So we have that valuation gap. How do technical strategists view the stock? Is this a momentum play or something more defensive?
It's fundamentally viewed as a defensive, dividend-rich name that is built to withstand a market pullback.
A safe harbor.
A safe harbor. Because the yield is high and the cash flow is stable, the stock tends to hold support better than high beta sectors when the broader market struggles. So for income investors, any pullback is seen as an attractive entry point.
And you mentioned the stock is cheap because of market skepticism. What does the institutional money flow suggest? Are the big players buying into this value prop, or are they still heading for the exits?
The institutional flow is mixed, which indicates some rotation. We've seen some large holders reducing their positions, likely for rebalancing. But importantly, we are seeing active accumulation from other major institutions. Epoch Investment Partners, for instance, recently acquired over 145,000 shares.
So there's sophisticated money buying in.
Yes. It tells you there is institutional sponsorship being driven by that combination of low valuation and robust, secure yield.
Okay, we've built a very strong bull case here, but we need to address the heavy anchor holding the stock back. The debt.
We do.
What is the biggest risk hanging over Verizon, and how significant is that debt load?
We have to tackle the high leverage head on. The bears argue that the heavy debt load is the single biggest threat. It limits financial flexibility, and it caps the growth potential, especially if that modest growth we discussed disappoints.
Right. And the capital intensity to maintain the network is also a concern.
It is.
So how does this narrative of cash flow and declining capex truly mitigate that debt risk?
The mitigation is entirely rooted in the mathematics of cash flow. Think of their debt as a large mortgage and their FCF as a massive, predictable income stream. The fact that the peak 5G capex cycle is over means that strong FCF of up to $20.5 billion is structurally positioned to do two things simultaneously: fully fund the growing dividend and apply billions annually toward deleveraging.
So it makes the debt reduction path predictable.
And mathematically sound over the medium term. Now, the second major risk is still competitive pressure. Skeptics argue the wireless market is saturated and that promotional intensity from rivals will just continue, leading to ARPU pressure.
And that is a legitimate fear, especially given how aggressive T-Mobile and the cable companies have been. How does the current data counter that argument?
The data counters it by showing growth is still achievable. First, 3Q25 showed actual service revenue growth between 2.0 and 2.8%.
Okay, that's 1 point.
Second, and this is more crucial, is the success in broadband. Connection growth of 11.1% year over year proves they are successfully expanding their addressable market.
So they're moving into the home internet space.
Exactly. A pie that is less saturated for them, and it supports those bundled ARPU numbers. They are not just fighting over the last slice of the wireless pie, they are growing a second business.
Looking ahead to the immediate future, what specific near-term catalyst is everyone waiting for to confirm this execution narrative?
The next major event is the 4Q25 and full year 2025 earnings report. Investors will be laser-focused on two specific things. First, execution against that huge FCF guidance of $19.5 to $20.5 billion.
Hitting that target validates the whole thesis.
It does. And second, they need to show continued acceleration in broadband net adds, proving that FWA can scale efficiently past its 5.4 million subscriber base.
What about the broader macro environment? What outside forces could serve as a tailwind for the stock?
Well, macro stabilization or anticipated rate cuts would be a huge tailwind.
Because
when interest rates drop, the relative attractiveness of stable cash flow, high dividend equities like this one, skyrockets compared to the returns you can get from safe bonds. Additionally, if market volatility persists, we often see sector rotation into defensives, making this a prime candidate for investors prioritizing yield and stability. So when we synthesize the entire investment thesis, the risk-reward looks highly compelling right now. We have re-accelerating growth driven by convergence and broadband, a fortress-like cash flow that is sufficient to handle the debt, and a low valuation, trading at a steep discount to intrinsic value.
That combination sets the stage for a potential multiple re-rating.
If they successfully execute on the deleveraging plan, yes.
And just to define the horizon, this isn't a stock you buy today and sell next month.
No, this is best viewed as a multi-year hold, likely 3 to 5 years, to fully realize the benefits of that FCF-driven debt reduction and the CEO's cost transformation efforts. Patience is the necessary element to capture the full reward. And this raises an important question for you, the investor. Despite the heavy debt, the company's commitment to returning cash, demonstrated by 19 consecutive years of dividend increases, and that anticipated structural drop in capital expenditures strongly suggests the deleveraging path is mathematically sound. The final determination you must make is whether you trust the management's ability to execute on the cost and cultural transformation plan over that time horizon, translating cash flow into shareholder value.
That's a powerful framework for making a decision. Thank you for joining us for this analysis. Make sure you subscribe to Smart Wealth with Joshua and tune in next time for another in-depth look into the market.